Well, good morning. Welcome. I'm University of Illinois Extension farm broadcaster Todd Gleason. You can find me online at willag.org, willag.org, or listen during the 2 o'clock hour to AM 580. We cover about two-thirds of the state of Illinois and about two-thirds of Indiana for that matter. And I do daily marketing. I also talk with the agricultural economist, the crop scientist here on campus, as well as the animal scientist as my primary job. And a lot of that shows up on the web as well as in the radio programming. Today, I'm hosting and moderating the last Financial Issues Before Planting webinar. It's part of the winter webinar series put on by the folks at the FarmDoc Daily. An agricultural economist from here on the Urbana-Champaign campus of the University of Illinois. We're going to go through a series of topics: price increases, the 2020 incomes, this year's incomes, the financial situation, strategies for this year, and looking forward into 2022. As we get started, we would like to thank our sponsors. They include the Center for Farmland Research here on campus, sponsored by TIAA, Compeer Financial, Farm Credit Illinois, Growmark, the Illinois Corn Growers, and the Illinois Soybean Association. Krista Swanson and Gary Schnitkey will be here to take up what's been happening with this series of financial issues. And Gary's going to kick us off. Hi, Gary. Good morning to you.
Good morning, Todd. And yeah, we're going to go through those 6 topics, and I'm going to start here with price increases. And obviously, that's the reason for our optimism right now. And this webinar is going to differ than previous financial webinars that we've done in the past or over the last 4 years. And we have reason for optimism. And again, price increases are leading to that. This slide just shows cash corn and soybean prices in central Illinois, and we've had a remarkable rise. We had corn prices below or near $3 in August 2020, and sort of we're expecting that to persist throughout time. But since that August 2020 period, we've seen those prices increase. And so right now in central Illinois, and this cash prices, these would be cash prices, we have a over $5 price, approaching $5.50 for corn, and obviously that has happened all across the state. Similarly, for soybeans, we've seen those prices rise, and we saw those soybean prices below $9, close to $8.50. It's earlier in the spring, and now we're looking at something over $13.50. So those cash prices have risen considerably, much higher than we would have anticipated in July and August of last year. And similarly, as we're looking forward in time and looking at fall 2021 prices, we would project those higher as well. One good gauge of that price increase is what's happening on projected prices for both corn and soybeans from a crop insurance standpoint. Those the corn price is the average of the settlement prices of the December 2021 contract during the month of February. So far this month, that has averaged $4.57. We got today and tomorrow yet in this month, so that $4.57 could vary a bit, but that's likely to be roughly within pennies, maybe actually a little bit higher than that. $4.57, what we should be expecting our projected price for corn. And again, last year it was $3.88, and before that we haven't had a price at $4.50 since 2014. So going back several years, we're going to be looking at a higher projected price for corn than we have in the past. That will allow us to set higher guarantees, and also brings us that $4.57 would be roughly $4.20 for a cash price. $11.82 is currently where we're looking at the projected price for soybeans is, and that's the running average through the month of February of the November 2021 contract. $11.82 is where that is at. We have today and tomorrow, and we'll have those projected prices set for sure. So next week we'll know that for sure, but $11.82 is roughly where that's running. 917 was what it was last year. So we're looking at a soybean price that is almost $2 higher than last year. And again, we haven't seen a price this high, or we are exceeding the 2014 price. And the last time we had a higher price was in 2013. So we're going back a little ways. So we're going to be setting higher projected prices for crop insurance. And our expectations then are for higher prices this fall. So we got a question for you. First poll. So we've seen that 2020 price up there. How much of the 2020 crop is left to price? So have we got most of it gone, or are we looking at having some of those pricing opportunities left? And again, if you're looking at grain that we held on our balance sheet at the end of 2020, if you still have that unpriced or priced it later in this year, we're likely to have a gain on those. So we're taking the poll. 65% of you have voted. Let's bring that poll up result, Jim, and we'll show you what you all said. And 4% of you, over 50%, 17% between 20 and 5 and 50%, 33, 10 and 25, 19, 5 and 10, and 2% less than 5%. That's a pretty typical range for this year. Maybe more of it has been sold than we would have anticipated at this point in time. In any case, we're going to now shift to 2020 grain farm incomes, and Krista is going to take that away. And we have one person saying hello to you, Krista. So good morning.
Good morning. Yeah, so 2020 incomes, 2020 incomes were good, and I would say unexpectedly good from what we would have thought about a year ago, if we think back to this time a year ago. And there are a couple reasons for that. First, 2020 yields were above trend in Illinois. So this shows a snapshot of the farmdoc budgets for central Illinois high productivity. And that region had a 228 bushel corn in 2020 and 72 bushel soybeans in 2020. And for reference, the trend line yields would have been 211 and 63. So you can see that we were quite a bit above trend, and those extra bushels certainly helped add to income. And the second reason was prices are good. And so again, going back to our January 2020 projections on FarmDoc, at that time, we were expecting 2020 marketing year prices around $4 for corn and around $9 for soybeans. So these are still projections. The prices we're showing now, the $4.25 and the $11.20, because we're still in the midst of the 2020 marketing year. But we definitely have seen prices a lot higher than what we would have expected before we went into the year. And so that's also boosting income in 2020. And then finally, ad hoc payments have really supported incomes, and not just in 2020, but really in 2018, 19, and 20. And when we say ad hoc, I'm talking about programs designed for a specific situation as opposed to our traditional farm programs legislated through the Farm Bill. So this includes things like the MFP, the Market Facilitation Program payments for trade, the CFAP programs for COVID, and disaster programs like WIP Plus that many of you may be familiar with. So these are those yellow highlighted figures, and those are some pretty big numbers relative to crop income. And if you look at the orange shaded box towards the bottom of this slide, you can see that the farmer return for a 50-50 corn and soybean rotation in each of those years, and look at it with the ad hoc federal payments as compared to where we would have been without ad hoc federal payments. And so in 2020, that would be $204 versus $147, or in 2019, farmer return was $14 versus a loss of $88 that would have been without those aid payments. So a really big difference in income in these years. And this is another look at the impact of those ad hoc payments on farm income. So the green bars here are showing operator and land returns, and the yellow line is showing cash rent. And notice that, since 2014, they've run pretty close together, meaning that on average, a cash rent farmer is at break-even level after making that cash rent payment. In 2018, 19, and 20, that orange bar is the portion of operator and land returns that came from ad hoc payments. And this is a big deal because these are not something that we've really seen make a substantial portion of income in the past. And so particularly in 2019, those were really critical to, keeping farmers above that break-even cash rent level. And in 2020, we probably would have seen a bar that looks a lot more similar to 2019 if we would have had those trend line yields and those prices that we were thinking we might have a year ago for 2020. So you can see that, where we maybe would have been and compared to where we're projected to be at now. And just a couple more notes on 2020 farm incomes. The relative spread between 2019 and 2020 is going to vary a lot from farm to farm because there's a couple caveats here. And one is that when the income from CFAP 1 is recognized. So CFAP 1 was really tied to the 2019 crop year, but a lot of farmers didn't receive that payment or at least a portion of that payment until 2020. So depending on where that ended up on their books may make a difference in, how 19 income looks versus 20 income. And another caveat is there's going to be a lot of variance between farms depending on their use of, programs like WIP Plus. The payments for that varied a lot from farm to farm. And then also, some farmers use the Small Business Association or Administration. Can't remember which that A stands for, but the SBA programs like PPP and EIDL, that's the Paycheck Protection Program and Economic Injury Disaster Loan Programs. And both of those, may have bolstered some income for some farmers, whereas other farmers may not have participated in those programs. And Gary, I think we're back to you now to talk about 2021 incomes.
All right, so we're looking at 2021 incomes, and again, we have reason for optimism here. We have very good prices, and so we're looking forward to those very good prices. We got a poll question here, and if you would answer this, how much of 2021 expected production is sold? So how much of 2021 have been priced already? We had a question about what are the sizes of farms, and I'm assuming that deals with our grain farm net incomes from Illinois FBFM. In 2020, those farms would average 1,500 acres, and there's a considerable range in farm sizes in there. So it's an average of farms for that year. And we have farms as low as 500 acres up to 8,000 acres, but the average would be about 1,500 acres in that farm size. We're doing our polling now on how much of 2021 expected production is priced. Let's end that poll and we'll show you the results. And 30% say less than 5%. Jim's bringing it up here. 21% say between 5 and 10%. 32% between 10 and 25%. And then 17% would be the combination of something over 25%. So it gives you a feel for what's priced right now. Our surveys would say that you generally by March, about 30% of the production is priced usually. I'm going to present three budgets for 2021. One has trend yields, and this, again, we're going to do Central Illinois. No to ad hoc disaster assistance. So what we're saying here is that for 2021, we aren't going to be getting another CFAP or MFP program, and we're using current fall delivery prices. We're then going to go optimistic. We're going to have above trend yields and no lowering of price. So we're going to get above trend yields, and we're going to keep our fall bids at those levels, and we're going to get $25 of ad hoc federal disaster assistance. You can guess or estimate whether that happens or not. And then finally, we're going to go to a back to normal trend yields. So we're going to do 217 and 68 bushels, 217 for corn, 68 for soybeans bushels per acre, $4 corn, and 1075 price. And by the way, those prices, corn and soybean prices, would be higher than what we've received from 2013 through 2018. So let's start with the baseline. Here's our baseline budgets, and you saw those 2021 values from the previous slides. So let's add our 2021 budget in there, 217 yield, 425 price. We come up and we've upped our non-land in cost to 571 to 580 for our operator land return of 342, and we subtract our cash rent, which we're assuming steady for 2021, for a $67 farmer return. Do the same thing for soybeans, 68 bushel yield. So we're at trend yield. 1190 is the price we're using. And again, we're coming close to fall delivery bids. We're increasing non-line cost to 368. And another important point is we're not putting anything in here for ARC PLC. At those prices and yields, neither ARC nor PLC would make payments. And we're coming down for a $166 farmer return, or 117 average over corn and soybeans. And you see that in the bottom there, 117 with ad hoc federal payments, which we have 0 in this slide, 117. So if that happened, I'm just going to put the bars up here, we would have for 2021 less income than happened in 2020. That 391 would translate roughly into $100,000 to $125,000 income on Illinois grain farms, maybe a little bit higher on average. Again, so that would be a very good year. It would be higher than our average between 2013 through 2019, with where that would be roughly 70,000 bushels, or $70,000 per acre. So no ad hoc payments and prices where they're at, and trend yields results in a very good year. All right, let's do optimistic scenario. So optimistic scenario, we do several things that cause those to change. We had 230 corn price, or excuse me, 230 yield per acre. So we're taking us back to above average yields, above trend yields, 72 bushels for soybeans, closer to the 2018 levels than we had before. And we're adding $25 of ad hoc federal payments. So that gives you a feel for our optimistic scenario. If we do that, we get farmer returns here of $194 per acre with ad hoc federal payments, and without ad hoc federal payments of $169. So that takes us up to, again, something like $180 for average farm income for 2021. If you've listened to our previous webinars, this is higher than we've done in the past. Again, what we're seeing here is higher prices. We haven't seen those prices they've been rising rather steadily, and they're still going on. So I attended an earlier seminar where your projected prices were around $4 and $9.80. Yep, you probably were here a month or two ago, and we keep increasing those prices. Um, and so there's where we're at. Now let me make the point here that one of the other things that is happening here is that we're seeing a great deal of volatility. We've seen, and one of the ways that we measure volatility, and this is on the grain price side, we've seen that grain price volatility estimate for crop insurance purposes to be 0.23 for this year. That's going to increase our crop insurance premiums, but it also is higher than last year's of 0.15. So if you're looking at the last 3 years, we've had 2018, 2019, 2020 for corn at 0.15. We're now going to be at 0.23 this year, 0.22, 0.23. We've got 2 days left. The estimate right now with 3 days into it would be 0.23. And as you can see, the last time that we had a higher one was in 2011. What that volatility indicates is that we have both higher upside and downside price variability. And a lot of that has to do with the fact that stocks are so low, corn stocks. To give you a feel for that, we're going to use a price distribution tool on farmdoc to estimate the downside price risk on the December 2021 corn contract. And here, the price at expiration, given what we're seeing in the options markets, we come up with that 0.23 volatility, and that would indicate that there's about a 30% chance of a price being below $4. And that's just using a Black-Scholes option pricing model. That would say that at harvest, there's roughly a 30% chance of having cash prices this fall at $3.80 or below, subtracting a 20 to 30 cent basis for that. So you can see 1/3 of the years we would expect corn prices to be below $3.70. Here's soybeans, and we would come up with roughly a 1/3 chance of being below $11 on soybeans. So, the scenario where we have back to normal prices is about the markets would say that there are about a 1/3 chance of us having $4 corn and $10.75 soybeans. So let's put that in our scenario. 217 at $4. So I went back to the trend yield. So we got back to trend yield and did put 62 bushels in there, 1050, sort of get back to that normal, if you will. And by the way, normal is when we say that back to normal, that's a higher price than we had from 2013 to 2019. We're down here at $11 farmer return on this average cash rent land, paying $275. So that would be roughly a $40,000 to $50,000 income. And again, if you're looking at these scenarios, coming down here to the bottom, baseline sort of 117, that gets us 125, 130 in net farm income, above our 70,000 average. 194, 169 in our optimistic case, high 100s, and $11 takes us down below 40 or into the $40,000, $50,000 range. So those load prices would take us back to something. So there is a possibility of that happening. Again, our scenarios here had the trend line yield in there. Maybe that's too pessimistic, but gives you a feel for where we're at. We're going to turn now. So we're generally pretty optimistic about 2021 incomes, and 2020 incomes turned out well. So let's talk about our financial situation as we're looking at it now. So, Krista, take it away.
Okay, thanks, Gary. Yeah, so financial ratios can give us a lot of insight into the farm financial situation. And I will say that I was just sitting here thinking that these, if someone wants to flip to the next slide here, these couple charts we're going to look at here now actually only go through 2019. So, given what we just talked about for 2020, I'm thinking that we would probably see a little improvement even from where we're at from 19, if we had 20 on here as well. This data is coming from the Illinois Farm Business Farm Management Association, and we're still waiting on the finalized 2020 data on that. So I just wanted to point out that these are going through 2019, but still can give us some insight. So this chart shows the current ratio for Illinois grain farms in that FBFM program. And the current ratio is a measure of liquidity. It's calculated by current assets divided by current liabilities. And we say that current assets are cash or assets that can be easily turned into cash, like grain in your inventory. Current liabilities are those things that need to be paid in the next year. So a current ratio of 1 would mean that the amount of current assets equals those current liabilities. So in 2019, that current ratio for Illinois grain farms was 2.03. And so what this means is that Illinois grain farms had twice the amount of current assets that would have been needed to cover their current liabilities. So although that's lower than that 2.87 peak back in 2012, it's still a pretty strong position to be in, to have, double the current assets versus current liabilities owed. And another thing to note here is that the current ratio has been pretty stable since 2015, and it's also stronger than that period going back before 2007. So again, a good position, and I think if we had 2020 on here, we'd likely see that, moving a little bit higher too. And so this is debt to asset ratio, which is another important asset, or another important ratio, excuse me. It's calculated taking total farm debt divided by total farm assets. And so in 2019, the debt to asset ratio for those Illinois grain farms in FBFM was 21%. And so that means on average that farmers have debt on about 1/5 of their total assets. And this is a little bit higher than that 18% low on this graph that we saw in 2012, but it's still a relatively low level of debt compared to historical debt to assets, I should say, compared to historical levels. Like if we went back to the 1980s, and even compared to those above 30% levels that we saw in throughout the 90s and the early 2000s. One thing to note here, though, is that just because we're at relatively low levels of debt to assets doesn't really mean that we have, I tripped up a minute ago and said historically low levels of debt, which is not true. Debt is increasing, but those asset values are increasing too. And so, this doesn't necessarily tell the whole picture because we're just looking at the debt relative to assets, but it's still good that we're at low levels of debt relative to assets. And another thing to be mindful of is that sometimes averages don't tell us everything we need to know. And so if we hop to the next graph here, we also wanted to show debt to asset ratio by age. So this is the same FBFM data set as the previous slide, but it's divided out by operator age. So first, looking at those red bars and operators below the age of 30, we see that in 2019, that group of operators had a debt to asset ratio of 53%, meaning that they had debt on about half of their assets. And if you remember to that average on the previous slide, it was 21%. So clearly this young farmer group, and looking at that blue or purplish bar of the 30 to 39 age group, the debt to asset ratio was 40% in 2019 for them. So we can really see that, and then you can see on down the orange bar and the darker blue and the green, that as we get moved to the higher age groups, we see that debt to asset ratio level improve and get lower levels of debt relative to the assets. And so young farmers tend to have higher levels of debt relative to their assets because they're becoming financially involved in farming and they're making big investments into land, building, or machinery. And that can put a temporary strain on the financial position and also makes them, a higher risk group. And so the other thing I want to point out is that when we look back over the last decade, we see that those trends by age have been really stable over that time. And you can really see the difference in debt to asset ratio by age. So now that we've covered, prices and incomes and kind of a recap of where we're at in financial position, we're going to talk about some strategies for 2021. So as part of running a farm business, studying financial records is just as important as doing the field work or feeding the livestock. And so the first strategy here is simply to just take a sharp look at your financial records, review those 2020 financial statements. I assume a lot of farmers get financial statements from their accountant already, but if you're a farmer listening and you don't, then ask if that's something that they could prepare. They have all your information already. They might have a system that makes that real easy. And for those in the farm business, farm management group, the FBFM group, they do a great job of that and prepare a historical trend as well. So you can easily look back and see how your financial health in terms of various financial stats and ratios has changed over time. And so you can review those financial figures and ratios like the current ratio and debt to asset ratio that we just talked about. And that can really provide valuable insight into how a farm business has changed. And I'd also just like to point out that it's really important to be familiar with those numbers and why they are the way they are. And also know that a weak ratio in a single year isn't necessarily a bad thing if there's a valid reason why. So when you go into a meeting with a accountant or a lender, that's why it's really important to I guess the goal of this strategy is to know your financial business status so that you can make those best management decisions and you can be able to explain your numbers and why they are the way they are. And kind of following up on that first strategy, the second strategy here is 2021 cash flow planning. So farm cash flow planning is just an important part of ensuring that you have an adequate level of income to meet the operational needs of the farm. And this can be a simple thing, or it can be really involved if you want it to be, and so you can use farmdoc budgets to start. You could work off your actual from last year and make adjustments as needed to reflect changes. One recommendation that we have is to use conservative prices and yields, or do a couple different cash flows that show where you would be at with different levels of prices and yields, just so you can see how that would impact your cash flow situation. And there are several fast tools available that can help with cash flow projections and evaluating those management decisions. The image shown here is from the Quick Cash Flow tool, and it allows you to see the break-even price. So I basically just threw in the 2021 budgets to do this, but it shows you your break-even price for farm operating costs. It shows that break-even price you would need to get a positive net income. And it also shows what you would need to get a positive cash flow, which is higher than just a positive income, because cash flow, might include things like family living or things outside of your business income, just achieving a positive income. So, and actually, there's an upcoming webinar here in March where Gary and Ryan Batts will be demonstrating some cash flow examples using fast tools. So if you're interested in that, that would be a good way to learn more about how to utilize those tools to your advantage. Okay, now we have another poll question. Do
And
you expect, and Gary, do you want to take it over?
no, I was just going to say, I put this poll together, and Krista didn't know I put it in here till now, but we wanted to get your feel for what do you think interest rates are going to do, and it's going to be obviously that has implications for this all here, and I can see that 39, 40. Come on, so let's continue to vote here, and we'll get to your answers here. Just because Krista's going to show a slide with operating and lending rates on the next slide.
Gary, why did you put this in? Krista,
Because
what is it you want to know?
so I want to know what people expect, because this has general implications for a couple of things. One is what happens to land prices, because land prices are likely high because of low interest rates. And there's also, we're looking at it, we do see significant debt levels out there, and there are financing opportunities, as Krista will show next slide, and stable to lower is 28%. Most everybody, 47%, less than 1%. So most everybody here, 70, my quick cowboy math says 70% are expecting that, are roughly stable to slight increases. So Krista, show us, and let me show you our next slide. And it's back to you, Krista.
Okay, yep, and that stable or slight increase in interest rates is, that would be continuing kind of what we've seen for several years, as you can see in this graph here. So agricultural interest rates are at historically low levels right now. So there's really not a lot of room to go down from here. So we either just stable or slight increases, or inevitably at some point larger increases maybe, are really the only direction that we can go. So this graph here was made using data from the Federal Reserve Bank of Chicago, their credit conditions for agriculture. And it shows the blue line is agricultural operating loans, and the orange line is farm real estate loans. And this quarterly data set goes all the way back to fourth quarter of 1969. And in that entire 50+ year period, the fourth quarter of 2020 had the lowest interest rates that we've seen in that time. So kind of interesting. But the interest rate is important because, like Gary just mentioned, a lot of farmers are carrying debt, and we just looked at the debt to asset ratios a little bit ago, and saw that, on average, Illinois farmers have debt on more than 20% of their assets. And we also mentioned, we didn't show actual debt levels and actual asset levels, but the debt levels are going up, and that debt comes with a price. And that price is in the form of interest. And so with these low interest rates, the debt isn't as expensive right now, but actually in the FarmDoc Daily article last Friday on February 19th, Brad Zwilling was the author of that, and he noted in there that agricultural debt has increased an average of 3.9% per year since 1990. And so if we assume that trend continues, and also in up cycles and positive income times, we tend to see higher input costs, and like Gary mentioned, tied to land costs, higher variability, and all these things tend to correlate with higher debts. So if that trend continues, and at some point we inevitably start to see an increase in interest rates, that's something to be prepared for. And now's a good time to look for opportunities to manage debt as we have some positive momentum and income. And so concentrating on paying down debts is good. Also, this historically low interest rate time provides some opportunities. Some farmers may be eligible to refinance some long-term debt at a lower rate. Or some farmers may have made, term purchases with cash, and maybe now's a good time to move that out to a term loan. and take advantage of locking in some lower interest rates while possible. So there's some tips on that, or some analysis on that, I guess I should say, was in the January 12th FarmDoc Daily article. But the strategy goal here is really to keep debt relative to assets in line and working capital at a sustainable level. In downturns, we tend to think about minimizing our costs, and what is the least amount we could spend on inputs to achieve a certain production level. But as we have some positive momentum in income, it's still important to think about managing input costs. But I guess I'd kind of reword or reframe this to say, how can we make management decisions to maximize profits? And that isn't necessarily the same thing as the least cost, and it's also not necessarily the same thing as the highest yield. So in this table here are just a few simple examples. Actually, in the August 25th FarmDoc Daily, Gary and his co-authors showed that with some new guidelines for the replacement rates for phosphorus and potassium, that farmers can save an average of $9 an acre without even impacting their yield. So this first column, or really it's the second column, the new replacement rate for P and K, kind of showed how you could maybe save $9 an acre, increase your net profit without changing yield. But then I also wanted to show, in the next two columns, just variable rate fertilizer, kind of just a hypothetical example here of maybe with variable rate technology, someone could increase their yield a bit without changing their costs. So out of the four columns here, this is the highest yield, but if you look down, it's not the most profitable. So going after the highest yield in whatever way that may be achievable may not correlate to the most profits. And then in the next column, another just hypothetical, maybe with a variable rate technology and fertilizer application, you could save some money, and maybe you give up a few bushels of yield. And out of the couple hypothetical examples here, that's the lowest cost, but it's also not the most profitable. So just like I said, a few hypothetical examples here just to kind of drive home the point that there's certain ways that maybe you can think about how can I maximize profit on the farm. And this is a good time to make investments into technology that allow for those variable rate applications, so you're not spending money where it's not needed or missing areas where it could be beneficial. And then the last strategy that we wanted to talk about today is just utilizing a marketing plan. And gosh, it's a challenge to market agricultural commodities anytime, but when we're talking about times with huge price swings, it makes it even more complicated. In the past year, we've had corn prices from under $3 to over $5.50, and soybeans from near $8 to over $14. Those are huge price swings. Even just in the past month, I just looked yesterday to look at the movement in cash corn prices and soybean prices over the past month alone, and we've seen corn moving over almost a 50-cent range and soybeans over almost $1 range. So it makes it hard to know when to pull the trigger on making those sales. And so and that volatility in the market can add to the emotion of making decisions too. So just finding a marketing plan that works for you or works for your farm. And again, I'm going to circle back to the cash flow strategy earlier. It's important to know your break-even prices, and doing that cash flow plan can help identify those break-even prices. I'm not much of a marketing. I'm kind of a marketing novice. I'm not an expert in this realm by any means at all. But I always like to think that a sale above break-even is not a bad sale. And so I think too that, if this isn't your strong area, then, working with a marketing advisor can be beneficial. But really the goal here is just to develop and use a marketing plan that can, help make marketing decisions. And I guess real quick, I guess I didn't even talk about the visual here, but this just shows Central Illinois cash bids by delivery month that I pulled recently, so it may be a little different now. But we can see here, thinking about marketing too, there isn't a whole lot of carry in the market by holding grain out to the summer months. And then we have the challenge of trying to figure out what new crop prices are going to do. Right now, new crop corn is running about $1 lower than old crop, and soybeans about $2 lower. And so, again, just thinking about a marketing plan and knowing when to make those decisions, finding a method that works for you.
So I'm going to take it away from here, and now we're hitting our last topic and looking to 2022. And I'm going to make the point here: with higher prices in the fall, expect rising input costs and upward pressure on cash rent. And then finally, we're also going to have to look at the longer run questions on levels of commodity prices. We have one more poll for you to do. And what do you expect anhydrous ammonia prices to be in the fall? We have it, and while you're taking the poll, I'm going to answer a couple questions here. And in your baseline model, all right, in our baseline model, we have corn being less profitable than soybeans. And we've seen that situation from 2013 on. How much do you expect this will impact planting of beans versus soybeans? Small shift, big shift in acres. I would expect Illinois, we would see a small shift to more soybeans, and we have been seeing that over the last several years. I would expect more of a shift in the Great Plains, and we'll likely see more soybeans in the Great Plains. And overall, wheat acres maybe taking a hit in the Great Plains, and overall corn and soybean acres coming out about even over the next years. We're got quite a few people voted on the poll. We'll bring that poll up here right now. And we have 50% believing that the price will be between 500 and 600 acres, 35% between $400 and $500 per ton, and 14% believe over $600 a ton. To put that question in a bit of context, here's what we've seen for anhydrous ammonia and DAP and potash prices over time. We hit some lows here below 450, sort of in the 420 range, and this is data from the Illinois Production Cost Report. That happened this year, and then we've been seeing that slowly rise. One of the biggest correlations between fertilizer prices is higher commodity corn and soybean prices. And again, I would expect those prices to be rising, moving into the fall. So we can expect those prices to rise, and I would also be expecting then non-land cost to rise. We're showing this through 2021. 580 would be our estimate for Central Illinois non-land cost, and 368 for soybeans. Again, that assumes that quite a bit of the fertilizer was and other inputs were priced this fall. We're going to find that those prices for fertilizers and other items are going to go up this spring. And again, I would be anticipating some pretty larger price increases going into the fall as well. I would also be expecting upward pressure on cash rents for the 2022 year if we still see prices, $4 and above for corn and, 11-ish and above for soybeans. There were a number of questions about cash rents going into the 2021 year, and we probably would have seen more upward pressure on 2021 cash rents had we seen these prices rise earlier in the year rather than later in the year. Many of the cash rents got set this previous fall, and before we began continue to see those upward prices on commodity prices. So coming into 2022, and again coming into the fall, we're likely going to be seeing those cost increase and those cash rents increase. We'll then begin to have this question: what is our long run prices going to look like? And right now, and this is the age old chart, we saw corn prices average something close to 240 between 1975 through 2006. And we saw those prices rise to 428 at the beginning, and we've averaged since 2007 428. Again, that was the beginning of the ethanol build, and we saw prices rise. That use of corn in ethanol and the continued strong demand for soybean exports led to those rising prices. But since 2013, we've averaged 354, 2014 to 2019. And now we're seeing prices well above that. Again, we're going to be seeing in later this year, or some of these months that we're looking at right now, average prices, close to 5-ish and above when all is said and done. And so the long run question about what will happen to prices, and my best guess would be that we're still looking at a long run price of corn near $4 rather than where we're at currently. So we're going to see those prices come back down. Maybe not for 2022, but you can expect a build in production capabilities, particularly in South America. So these high prices are going to bring on acres. Can't do it this year, but maybe in the next year. And the same thing for soybeans. We're looking at higher prices. So we're looking at higher prices now, and probably those coming back to that 10.50 range for the longer run. So as we build those higher costs coming in, build in those cash rents, we're in this period again where we're likely to have some better incomes for a while. After that, we have those longer periods where we again have steady to low incomes, and it being a more difficult financial situation. We have a question of where do I think fertilizer prices are going to go? And I was going to say that I was going to rely on you, but I wouldn't be surprised if we saw those anhydrous ammonia prices as a benchmark $550 to $600 this fall. Again, it depends on what we're looking at as far as price wise. So summary here. What are we looking? We got another. We have a couple good questions here. Prices of many ag commodities are at their highest level. Incomes, and we're generally more positive than we have been in the last 4 or 5 years. But what's going to happen, as it always does in agriculture, is we bid up cost, and then we'll have another period of where we're at. So, Todd, we have to thank our sponsors and note our tools.
Thank our sponsors. We need to tell folks where they can find the archive of this, including all the answers to the polls that we've already taken. You can always find those on our FarmDoc Daily website. But don't forget about the crop insurance tools that are there as well. In fact, I believe the tools are in both the FarmDoc and the FarmDoc Daily websites. Those are two different websites. The webinars as well. So across the top there, you see tools circled. You can find all the crop insurance tools. You'll be wanting to use those in the next couple of weeks. We would like to thank our sponsors. They include TIAA, Center for Farmland Research, That's farmland.illinois.edu here on campus, and is operated by Bruce Sherrick. So if you want to visit that, you can do that. Compeer Financial and Farm Credit, both are sponsors of this winter webinar series. Our thanks go to them, along with the Illinois Soybean Association, the Illinois Corn Growers Association, and FS Growmark, as well as to the College of Agricultural Consumer and Environmental Sciences and the Agricultural and Consumer Economics Department here on the University of Illinois campus. Don't forget, we have some upcoming webinars. They include next Thursday, the final look at commodity titles and crop insurance decisions. Gary, you'll be here for that one, and I know folks on that Thursday will be really interested to hear what you have to say about some final decisions as they go into that March 15 timeline. And then we'll do fast tools and financial planning on March the 11th. Make sure you join us for that. And again, don't forget that you can submit your questions right now if you want. We'll try to get to as many of them as we can, and that you can always find this YouTube up on our website at farmdocdaily.illinois.edu. Have you been going through the questions, Gary?
Yes, I have, and so we'll take a couple of these here. One of those is what's happening to variable rates. Or excuse me, yeah, our example we had. You're absolutely right. It would probably increase application costs, and you are right there. We have a question. This is not our bailiwick, but we'll give you an answer anyway. What are we looking at for weather for the 2021 growing season? And I'm going to give you the answer that Daryl Good would always give you, and that is it's normal until you say that it's not normal. And so.
Okay, we have a question asking about if there's an update on that CFAP payment that was approved in December 2020. So that's referring to the stimulus bill that was passed just before Christmas. It provided for $20 per acre payments for row crop farmers, and the USDA had not proceeded with that. And when the Biden administration, when Biden took over as president, he put a pause on that. And actually, there was just some news on this yesterday after Vilsack was confirmed that they were going to be coming out with more information on that in the coming weeks. So hopefully we'll know more about what's going on with that in the next few weeks. They also did note that for the revision that some producers were eligible for the CFAP program, there was originally a deadline on that, I think around March 1st, if I remember off the top of my head. And they announced yesterday that deadline is not going to apply, and they will be continuing to accept those revised applications for those that are eligible for that. So that's all we know on that right now. Hopefully in the coming weeks we'll have more.
We had a quick comment. I cannot open the tools with my iPad, and if it's a spreadsheet, it will not work on the iPad. And we haven't figured out a way of getting.
Yeah.
What's that?
An Apple, like the tools don't work on a Mac either.
Actually the ARC PLC tool will work on a Mac. It will not. It won't work on the crop insurance decision tool.
The crop insurance decision tool does not.
I don't know if we know the answer. Have you more information about SA producers not honoring their low price contract sales? How widespread with processors?
That keeps coming up on the radio the last couple of days, and the answer is we do not know how widespread that is. However, the answer in the United States is this: National Grain and Feed Association, Illinois Grain and Feed Association are the way we get around that, and so are the way both the elevators and the end user, or not the end user, but the farmer are protected, and so those are a couple of things that are in place here in the United States legally that are not clearly in place in other parts of the world.
So we have come to the end of our questions. It is noon. We will be back here Thursday, 11 a.m. Is that March 4th? Yes, that's
March 4th, yes. You will be back in studio, Gary, and I will be here Thursday next week at 11 a.m. Thank you, Gary, for being here. Krista, thank you for being here as well. We appreciate that. Again, if you all would like to join us next week, you're already signed up. You're going to get an email about this. It is Thursday, March 4th, and we'll continue our winter webinars. Our thanks also go to Jim Baltz, who's behind the scenes and has been doing a fantastic job of operating everything, including putting the slides up in part, or at least making sure you can see them really, really well, and operating the poll. So thanks to him as well. I appreciate that much, and we appreciate you being with us for the day. You have a good day, and hopefully the weather will be good as well. Bye-bye now.
Bye-bye.